Well, I want to welcome you all to another one of the Bootcamp series. Now, before I introduce Daryl and Chris, I just want to make a quick comment because this conversation is mostly going to be between you and Chris Pedersen. But this was supposed to be the ninth in a series of these Bootcamp presentations. And the reason that we make it last is because everything up to that point has taken you, if you go through the first eight of the series, it will take you through the process about equities versus bonds and what equities and how to combine them and how to add fixed income and how to add money into them during your accumulation years and then how to take money out and then target date funds. And so we finally get to the end of the series, the ninth piece. And that focus is about what actual specific investments you make. There are thousands of ways to combine a bunch of different equity asset classes. But I think there's some magic in the actual ETFs that you might put your money into. And of course, that magic will be either better performance or worse performance. So we're moving this way up in terms of the release because I know that many of you are waiting, and this is the part you really want to know is what are Chris's new recommendations. So before I talk to Chris, I will talk to Daryl. I just want you to know that Daryl and I are going to be really passive in this presentation, but we're here to ask questions if they come to our mind. But Daryl is the one who has been responsible for putting all those amazing tables together that we have on our website, that as you go through about one through seven, all of those boot camp series, you're going to see Daryl's work. And it is so helpful to me as the teacher to have the access to those tables to help tell the stories. So Daryl will be here along with myself to watch and weigh in from time to time. But the person we're going to be focused on today is Chris Pedersen, our Director of Research. And I noticed in a recent piece that you did, Chris, that you were introduced as the Director of Education. And I don't know which one you prefer. I suspect you could fulfill either one. But Chris changed my life and the life of the people who follow our work. And the reason he did is because he came in and he simplified things. He took us from 10 different mutual funds or equity asset classes down to 2 or 4 with virtually the same return. It's not magic, but it's certainly meaningful for people who have to do the daily work or annual work of taking care of their portfolio. And then he did the work to create the best-in-class ETFs, taking the time to do what is in many ways probably the most difficult task for people. Because if you, for example, if you watch the first boot camp about stocks versus bonds, once you get that, you got it. You know that you want to have, if you're an early investor, a lot of stocks, if not all equities in your portfolio that's for the long term, and that bonds are going to slow you up in getting where you want to go. So that's a pretty easy lesson. And then you simply have to have the discipline to do that. But where it gets dicey, I think, for people is wondering, okay, I've got these 4 different equity asset classes. What fund should I be in? What ETF should I be in? And to the extent that the ETF that you are in, that Chris recommended, let's say last year, hasn't been the hot performer, now you're wondering, well, I wonder if we've made some mistake. And so you go through this process of questioning, am I doing the right thing? And so Chris is here today, not only to update us on any changes in the recommendations, but to explain for people who are here for the first time, how does he do this analytical work? How does he decide that one ETF for the long term should be better than most of the others? So, Chris, I can't thank you enough, just as I feel about the work that Daryl has done. You guys have certainly changed my life. I really mean that. And I'm excited. I have not seen this presentation, so I am quite excited to see what you have to say. And so the floor is yours.
Well, thank you, Paul, and thanks, Daryl and Paul, both of you, for being here because I think you have a lot more to offer than just sitting in the background. And I hope we have some interaction and discussion as we go because there's a lot that goes into actually understanding this process and applying it. And so, please don't hesitate to chime in. And my title hasn't changed. Tom Cock just I think he misspoke when he introduced me. I'm still the director of research, but it's a little organization. We get to have highfalutin titles.
Right.
Basically, Daryl and I turn cranks, right? So the crank we're turning today is one I promised to have done by the end of February, and it is February 27th, right? I mean, we're like right at the edge. This was one of the hardest updates of the best in class ETFs that I've ever done, primarily because there have been a lot of new funds that came along. And I wanted to do some things differently to be more transparent and help investors make good decisions. And so we got a lot of change. Let me share the document here. Okay, so I didn't want to bury the lead for people who followed our work for a long time. We're making two communication changes this year and four fund changes. So the two communication changes, the first one is that we are including a relative factor predicted expected annual return for each fund in each asset class group. And you'll see that later, but what that means is there's a number next to the fund and if the number is one, that means that there's a 1% per year expected return higher than the worst fund in that group of recommended funds. And you'll see where that number comes from as I go through my process and describe it. But the reason it's there is to help you if there are costs associated with changing from an investment that you currently own to a new one, that you can get an idea of how long it might take to pay for those expenses, right? If there are taxes to occur to be paid in a taxable account, for example, you might look at it and say, well, if there's only 0.25% difference in expected return, then maybe it's not worth making the change. So I think that transparency will help you make smarter decisions. The second thing is that we're breaking out the mid-cap value asset class. And the reason we're doing that is that the fund that we've historically recommended for large cap value is actually better characterized as a mid-cap value fund. And so we now have a recommended fund that is truly in the large cap value asset class. And you can also see some alternatives in the mid-cap value asset class if you want to either stick with the fund that we had recommended in the past or go with something else. So those are the two communication changes, and you'll see those later. And then the four fund changes that we're making, and this is more than I'd like to make. I would really like it to be stable forever, but when new funds come along or new performance track records come along, I have to follow the data. And some people will say, wow, you have four new Avantis funds recommended. Are you just like totally biased towards Avantis? And the answer is no. I followed the data and I'm being transparent with the data. I'm sharing it with you so you can see it. These funds they are the best in their asset classes for what we recommend. And so Avantis Large Cap Value replaces the S&P 500 Pure Value Fund that was previously an Invesco fund that we had selected. And that's because, as I already said, that RPV fund is more of a mid-cap value fund. So this is more representative of the asset class. You still have the option, if you want to tilt a little bit more to small and use RPV, and you can see the difference in the relative returns in the data that I'll show later. The second change is the Avantis Small Cap Equity Fund AVSC replaces the iShares S&P Small Cap IJR. And you'll see again that it has a higher expected return, and that's why the change. And then the third change is AVDS replacing the Schwab Fundamental International Small Cap FNDC. And again, it has a higher expected return. This is a factor predicted expected return, so it could underperform for years. We don't know when that'll show up, but we just have to go with the data. FNDC, though, is still in the M1 portfolios, the M1 pies. And the reason is that AVDS is not yet available on the M1 platform. So, this is one of the reasons we give you multiple fund choices, is that you may not have access to the one that we chose as best in class. And then the last change is the Avantis Emerging Market Small Cap Equities AVEE replaces the iShares MSCI Emerging Market Small Cap EEMS. It's quite a bit less expensive, and I think has a very good chance of outperforming, and its track record says that it should. So those are the changes, but to really understand why you might care about any of these recommendations, I think we should go through the process. Did I miss anything or confuse anything here, Paul and Daryl, at a high level before we go through why people might want to go with the choices?
I think that was great. I have a bunch of questions already on my piece of paper here, but they really are for the time when we dig a little deeper into the choices.
I think it's a good intro.
Okay, let's go through the process then. I just didn't want to bury the lead. So, for people who've followed our work. So I'm going to back up just a little bit and say, how do academics come up with these ideas that investments are driven by a particular set of values? Well, it's a lot like the way chefs come up with how flavors drive the way we perceive food. So if you go to a chef and you say, how do you construct a great meal? They're going to say, well, you mix together a variety of complementary flavors. It's not all firing on one dimension. It's going to have maybe a little bit of sweet and sour, maybe a little bit of spicy too. And those things are going to combine to deliver a really great experience for the palate. Well, academics have taken a look at what drove historical performance in investments, and they've come up with the same kind of intrinsic ingredients. They've said, what are the attributes that drove returns? And they've come up with a variety of different models. So you get to pick one. There's in the same way I might be able to describe a car with a different set of specifications, there are lots of different ways to characterize the market. I like to go with the Fama French model because it comes from academia. It's not evangelized by somebody trying to sell me something. And this is their 5-factor model. It says that there's a market risk. That's the risk we take for being in equities. And that historically has driven the lion's share of the return, actually, for equities. But then there's also an additional risk that you can incur for investing in small companies. And for that risk that you take, you get a premium, you get an additional return. There's also some risk for investing in companies that are out of favor or value companies. They sell at a discount. So you can get more shares, if you will, compared to the value of the underlying assets of those shares for the same price than you could in a high growth company that is kind of a glamour stock. And historically, you've been rewarded for that. You can also get a higher return historically for investing in companies that are more profitable or more conservative in their investments. And so those are the 5 attributes. And there are also attributes for bonds, term and credit. And we're going to ignore those for right now because my focus today is really mostly on the equity choices. And those attributes, you can actually go back and you can create a graph for how the market risk has delivered over time. That's the bottom left-hand graph here. You can look at how size premium has delivered over time. That's the size factor chart, the value premium, the profitability factor, and the investment factor. And you can see historically when those attributes have delivered their premiums and how big they've been. And then you can take a fund like DFA's US Small Cap Value Fund, and you can run a regression analysis on it. You can basically do some math, and you can figure out how much of each of these attributes you would have to add together. Think of them as ingredients, right? To model the past returns. And you can then, over on the right-hand side, you have this thing called alpha. That's what's left over after you combine those ingredients. And you would expect the alpha to be negative because people are going to charge you money to run the fund. And so in my analysis, I include negative alphas. I don't include positive alphas because I don't think there's any ability to really be a genius beyond these attributes. And then finally, over on the right, there's this thing called R squared. And that just tells you, well, how good is the model? How much of the returns does it model out? And it says that it predicts the past returns by about 97.5% in this case. And if you take all those elements and you add them up in those ingredients, this is what you get. So the blue is the actual fund response over time, its actual performance, and the, I'm colorblind. Is that orange, green? What's the other color?
Red.
The red. The red is the 5-factor clone. And you can see it describes what happened very, very accurately. So this is all giving you basically the science. It's like there is some science behind analyzing a fund. But to get to these premiums, to get the benefits, you have to tilt. Some people would say, well, you can buy the whole market. And if you buy the whole market, you've got small, you've got large, you've got value, you've got growth. But the value offsets the growth, the small offsets the large, and you don't actually get any of the premiums. All you get in a total market fund is market risk. So that's why Paul's portfolios, the ones that we recommend, all have a disproportionate amount invested in small or in value. It's so that we get that tilt. And when we're looking at these funds, we're looking for that same kind of tilt. We're looking for a fund that has a disproportionate amount in small, a disproportionate amount in value, and ideally also a disproportionate amount of companies with better financials. So how do I pick the best funds? Well, obviously we'd like it to have a low expense ratio. We would like it to be efficient and have low turnover. We'd like it to have stable style, be consistently in the asset class it says that it is. We'd like it to be small. We'd like it to be cheap. And there are a variety of ways that you could go and try and search for that. One of the simplest is you could go to Morningstar. And I do use Morningstar, and Paul often recommends you go to Morningstar. And if you did that for these 2 small cap value funds, DFSVX on the left and VISVX on the right, what you'd find out is that they have different expense ratios. These are, like I said, both small cap value. The DFA fund is a 31 basis points or 31/100% per year expense ratio. The Vanguard fund is 19 basis points of expense ratio. But then you can look under the hood kind of, and this is all driven with that same sort of regression analysis, and you can look at them and go, well, the DFA fund is a little bit more value-y, and the DFA fund, let's see, it has a little bit worse momentum, and it's got a little bit higher, actually it's about the same on yield. Its quality might be slightly higher because I see a light blue bar that goes up higher. The volatility about the same, the liquidity about the same, the size, the DFA one's a little bit smaller, But what you can't tell from this is are the little bit of advantages that you get in a little bit more value and a little bit smaller size going to give you an expected return that's high enough to offset the difference in these expense ratios between 0.19% and 0.31%? You can't figure it out, right? And so to do that, you have to run some numbers. And the tool I use to get a lot of these numbers is Portfolio Visualizer, because Portfolio Visualizer will let you run a factor analysis on an individual fund. It will also let you download factor return statistics for a variety of funds. And so I go there and I get this data and I pull it down, and then it lets me take this fund like DFSVX. Remember, we're comparing DFSVX and this Vanguard fund and trying to figure out which one is better. And you can figure out how much exposure that fund has to each of these attributes and how much those premiums have been worth historically. And then it's just a matter of multiplying them together and adding them up. And what you get down here in the bottom right for US small cap value for the DFA fund is 8.6% above risk free. And what you get for VISVX is 7.3% above risk free. So it's a lot of math, it's a lot of calculations, but at the end of the day, what it says is that after expenses, the DFA fund has a higher factor predicted expected return. So if I was going to be a rational investor and follow the data, I would choose the DFA fund, even though I'm going to pay a little bit higher expense ratio. And that's really the gist of the core of how I pick when I'm picking the best in class funds. So that was a lot. Daryl, Paul, slow me up. Like, what did I say that was confusing?
I think if you could just take one of these exposures and talk about the percentage exposure that you're getting, make sure that people understand that relationship. I don't care which one you want to do, but just to run through it kind of step by step.
Okay, yeah, I think that's good. So thanks for slowing me down. So this DFA fund has 105% exposure to the market risk factor, which means, and there's some uncertainty in these numbers. It's possible it's 95, it's possible it's 105, it's possible it's just 100. But what that says is you're getting in this fund almost all of the market risk. And historically, that risk premium has been worth 5.52%. Now, this was a slide from a couple of years ago. The actual premiums this year are a little bit different, subtly different, but they don't change that much because the premiums are based on data going back to the 1960s. Mm-hmm. So basically, you take the 105% times 5.2%, and that's going to give you, I don't know, 5.6%-ish, something like that. And then the size factor, you're getting 86% exposure to the size factor. So not 100%. It's hard to get 100% in anything after, if you get 100% in one of these attributes, it's hard to get it anywhere else because they're not in the same stocks, right? You have to choose different things to get different benefits. But still, 86% is a lot of the size factor. And that premium has been worth 2.18%. And then you're getting about 45% of the value factor exposure in this fund. And that premium has been worth almost 3%. And then about 13% profitability and 7% investment, and those were worth 3%-ish each. So you basically do that multiplication and you add them up. And that's how I get that factor predicted expected return. So we just went through it for one fund on a PowerPoint, but what I need to do for each of the asset classes in selecting for the best in class is compare all of the funds that are similar. So this is the small cap blend category out of my spreadsheets. And so what you see up here at the top these are the premiums for the market, the size, the value, the profitability, and the investment attributes going from 1964 to 2024. And then for each of the candidate funds over here on the left-hand side, you can see they have to be analyzed over the same common dates, and they were. And then when I go to Portfolio Visualizer, I get this kind of data. I get data that says what the annual alpha was. So that's the leftover. It's, did the fund have expenses? Did it have trading costs? Did it do equity lending that it didn't compensate for? Did it get front run in the market? Did people get in front of its trades? There's all kinds of reasons it could be negative. There really aren't any great reasons for why it should be positive. So if it's positive, I ignore it. If it's negative, I include it. And for each of the attributes that it shows up here, so the exposure to market, size, value, all of these, there's also this value called P. And the P means kind of what's the confidence in that piece of information when I ran the regression. And so it's actually high confidence when it's 0 and low confidence when it's 1. So it's kind of the reverse of what you might think. And so what I do is I multiply all of those attributes times 1 minus the p-value, and then I add them up. And so that means if there's low confidence data, it gets thrown out effectively or reduced. And if there's high confidence data, for example, you look at the market risk factors here, they're all 0. That means very high confidence that is a real variable, that there is real market risk. But if you, in contrast, look at the alphas, the variables there are 0.6, 0.7, 0.3, 0.1, 0.5, 0.6, it very low confidence in the alphas. So they get reduced if they're negative. They get eliminated if they're positive in my analysis. And then over here on the right, you get the factor predicted expected returns for each of those. But what I do then is I normalize it for the category. So I say the lowest one in the category is 0, and then you can see the category relative expected returns for each of those. And you'll see that on the chart at the website. So we'll come back to that. And this chart is on the website. You can see it. It helps you to understand how I run the numbers, and you can even see for the example AVSC down here how all of the numbers got run and what they added up to.
So in your ignoring the alpha when it's plus, you are basically concluding that the excess alpha was luck. Is that a fair conclusion?
Yes.
Okay.
Yeah.
So
I'm basically saying that all of the academic research I've seen says that one of two things is true. Either there aren't people who can figure out how to beat the market, or they charge you what they beat it by. Right? So there's very little evidence there's any way to invest in a fund that is going to outperform the parts of the market that it's exposed to, and do that consistently. And if there was a way to do it consistently, somebody will probably figure out how to arbitrage that away in time. So even if somebody's doing it, it probably won't be long-lived. Yeah.
So the other question, Chris, is I know you get people who write to you and say, what about this ETF? Can you tell me how it looks on your scoreboard or do the analysis for me? Is this something that people who are technologically or statistically oriented and educated should be able to run on their own?
Yes.
Yeah, okay.
Yes, absolutely. So part of the reason I am as transparent with the process is that you can go to Portfolio Visualizer and you can get all this information and you can build a little spreadsheet it's not sophisticated math. It's just, multiply and add. And so you could do it. Now, as I'll explain in a minute, the actual process I go through does get slightly more complicated. Okay, so to Paul, to your point, could somebody do this? Yeah, absolutely. You can go to Portfolio Visualizer, and you can actually run this five-factor model on U.S. funds, and you can filter on, for example, an R-squared value that's high enough that you're only going to get index funds, not active funds. That's why I have that highlighted. And then you can click on this little Excel box and you can download all of the data. You can go get the 4,000, what is it, 2750 funds here, and then start having a great time. So it's definitely doable, and the interested student, it can have at it and have fun.
Yeah, we have to remind them that you are volunteering your time. And there is obviously a ton to get done without doing that extra work. But I think it's great that they can do it on their own.
Yep. So, when I do that fund analysis, it is more than just the spreadsheet, as you well know, because then I go to Morningstar for all of our candidate funds and I look at the expense ratios, I look at the number of holdings, the number of companies that are in each fund, I look at the turnover, I look at the R squared out of the regression analysis, I look at the parent company, I look at the methodology of how the fund is managed. And it it's very iterative, as you guys know, because I've presented you, I think, with three sets of recommendations before we got to the final. And in fact, if you look at the real process, it's got lots of steps, and there'd be arrows going back and forth all over the place on this chart if I really described them all. So it takes some time, but it gets us to the point, though, that we can update the website and provide you with the new recommendations, and that's where I want to go next. Okay, so how do you find these recommendations on the website? It's pretty easy. You go to the top of the website to the pull down that says Portfolios, and right under that, there's this 2025 Best in Class ETF updates. And you just click on recommendations right there, and that'll take you to the update page. And you'll see on that page that we've updated the portfolio configurator and the Merriman Aggressive glide path target date glide path asset allocation calculator as well. We've also updated the M1 pies to the extent that that's possible, because they don't have one of our funds, but they have all of the others. And what I've done here is, for the changes, they're in highlights. And I really like to keep as few changes as possible, but I also am going to make a change when it's justified. So for example, US large cap blend is the same that we had before, AVUS. And if you look at it, this category has the least variability of most of the categories, because this category really consists of large companies in the United States for the most part, in S&P 500 funds for the most part, and they just don't vary very much, and they're very inexpensive. The fund that we recommend, this AVUS, is actually more diversified than an S&P 500 fund. But for that diversification, you also get a little bit higher expected return, because the way Avantis runs the fund, they disproportionately weight companies of higher quality. And they also tilt just a little bit towards small in value. So that's why it's there. But in terms of differences, it's a 0.9% relative return in this category compared to 0% for the Schwab large cap blend. This 0.9% is relative to the other things that are in the box that is bounded by black, which is just the large cap blend category. And so the lowest one there is this Schwab large cap SCHX. If we look at the next category where we have a change, where Avantis US large cap value replaced the RPV fund, it actually has a lower expected return than RPV. So why would I have made that change? The reason I made the change is to be more representative of the category. So if you compare the large cap value space with RPV is really more of a mid cap value fund. And so that's part of the reason it has this higher expected return. And I'm being transparent so that if people want to use it, they can. But to be fair, I'm also adding in some other mid cap value funds that you might choose among. There's an Avantis one that has a higher expected return, although for a shorter history than the Investco S&P 500 Pure Value. And there's also a Vanguard fund listed there that had a little bit lower expected return. So you have a choice here, but we're making that change because it represents the category more accurately. And if you go with that, it's going to more likely, it'll have a higher likelihood of following the results that show in Daryl's charts.
You know, Chris, it's really interesting as I look at the large cap blend. And when you look at the total market index for Vanguard, there's a 0.1% versus for the S&P 500 from Vanguard, a 0.2%. And that means I would expect the S&P 500 to make a small difference. And this is coming out of your study. It is also interesting to note that from 1928 until the end of 2024, the advantage to Vanguard, to the S&P 500 was in fact about 0.1%. And so it is looking very much like the history of those two equity asset classes. And I might also add that in conversations with people at Avantis, the question is, with their studies, how much more should the AVUS make because it has more value and average size companies are smaller? They think it's somewhere between 1 and 1.5% without taking fees into consideration. So again, it looks a lot like the conclusions that you have come to with your analysis.
Well, I'm glad to know that we can triangulate and agree with multiple different ways of looking at it. They should agree because they're all based on the future looking at least a little bit like the past. Yeah. So the next category down is U.S. small cap blend, and we are making a change there as well. And you can see the Avantis U.S. small cap equities AVSC as a replacement for the IJR fund, and the difference there in expected return for the history that is in common since February of 2022 is goes from 1% to 2.8%. So it's almost a 2% advantage. And so even though the history isn't as long, I felt like that was pretty strong. But if you're in, say, DFAS or you like DFA instead, its factor predicted expected return over that same time frame was 2.4%. So pretty close. So, you can, that's what I like about putting those percentages in there, is that lets people see, are they similar? Are they way far apart? Are they close together? And the larger the market, the larger the category, the closer I expect them to be. So then there's a number of categories where our recommendations stayed the same. Two of them worth just discussing briefly would be U.S. small cap value. It's not the highest factor predicted return in that category, the AVUV fund. The highest predicted return there is for RZV, which we have recommended in the past, but RZV holds a lot of micro caps. And that makes it very volatile, and it has underperformed for long periods of time. So in that category, I favored AVUV because it's had a higher return per unit of risk. RZV has also historically had times when it went through periods of large negative momentum that dragged its return down. So that was a combination of not wanting to whipsaw our investors, but also wanting to recommend to them what we believe, for a variety of reasons, still has the highest likelihood of helping them out. Yeah.
So, Chris, I noticed in that table you showed us that Daryl had brought up that in those small cap blend, the one right at the bottom with the worst track record was the micro.
Oh, the microcap IWC. Yes,
Yeah.
right here. Yeah.
So I was curious when I saw that whether if we talk about size, I can imagine somebody asking, wait a minute, if there's a premium for size, why wouldn't the smallest give us the biggest premium? And I don't have the answer. Do you?
Well, the way I like to think of it is when you're buying these funds, you're always buying a multi-factor fund. So on the one hand, yes, the Russell Microcap IWC is going to have more exposure to the size attribute, to the size factor. But once you get into that universe, are you going to have a smaller selection of companies with good profitability?
Right.
Are you going to have a smaller selection of companies with good investment? Are you going to have a smaller number of companies with a favorable value nudge, even if it's just a nudge, because this isn't a value category, right? So I think whenever you reach extra far for one of these attributes, you make the sacrifice of not being able to get as many of the others. And so and you also tend to end up with a portfolio that is more volatile. And because it's firing on one or two cylinders instead of five or six, it's less consistent in when it delivers that premium. Yeah. So I think the
So
IW
it's kind of a diversity argument,
diversification argument. Yes,
diversification argument. Yeah.
absolutely.
Yeah.
Yep, that's absolutely right. And I think there's an opportunity in the small category to get a wider range of diversification than there is in the micro cap category. Yeah.
Right.
So that was the small cap value. The international large cap value also is not the highest factor predicted return. I went with DFA's DFIV. That was our previous recommended fund compared to EFV, which previously had been recommended by us. But again, if I extend the analysis here, the factor regression analysis, to a longer period of time, then DFIV actually has the higher expected return. And since EFV has come in and out, I didn't want to whipsaw investors, and so I stuck with the DFIV, and I believe it has better methodology and other reasons to stick with it. So, you can see there's a little bit of art in here. It's not all just numbers, but if you just like the numbers and you want to go with that, I'm transparent. You can go pick EFV. International Small Cap Blend, we are switching from FNDC, which actually, even though it's called an International Small Company Fund, recently has been sitting more in kind of a mid-value space. We're switching to AVDS, which is a new Avantis International Small Cap Fund that better represents the category. And we do like the methodology of Avantis. Now, the one thing people may want to be aware of with AVDS is that it's relatively new, still smallish. So in trading it, you'll want to set limit orders probably in terms of just watching for bid-ask spread. And then finally, the Avantis Emerging Markets replaces the EEMS. It's significantly less expensive and over the same time period had a significantly higher expected return. So this one seems like a fairly straightforward change. It's got more and smaller companies with better financials and higher factor predicted expected returns. So those are the changes, the rationale and summary, and some facts are on the website. And probably the other cool thing to just check out quickly is that if you go to the portfolio configurator on the website, these changes are all live, and you can do some fun things, like you can choose the fund family, go down to the best in class ETFs, and this will show you all of the different portfolios that we have using the best in class ETFs and their average expense ratio, which is 0.24%. And you can compare that to, say, Vanguard. And when you compare, what you see is that Vanguard is a little bit bigger and a little bit less value-y at 0.09% expense ratio, and a little bit cheaper, right? You can do the same thing with Fidelity. You can look at Schwab. You can look at T. Rowe Price. They're the most expensive and least value-y. And you can also look at the Vanguard mutual funds. So you can play around with that, and then you can pick your portfolio. Let's say you do ultimate buy and hold 50/50 US in a tax deferred account, and it'll bring up all of the funds that you would use and the percentages you would use to achieve that particular allocation. And if you change the fixed income percent, it'll bring in the fixed income and give you all of those calculations as well.
And one of the things we talked about in one of our meetings was the recommendations that are coming out of people like Wealthfront and Betterment. And our goal is to put as much money in the people who follow our work in their pocket as possible. And I suspect that many of the funds or ETFs that they are recommending are in some of those tables you're building, except that what they're recommending has a much lower or somewhat lower expected return. I think that's something that would be important to people, because, boy, wouldn't it be nice if you just could throw your money into Betterment, pay them 0.25% or whatever it is they charge for larger accounts. I think to some point they're free, but you are going to get what they consider to be the best ETF in those asset classes. And my question is, are they the best? Well, the only person I have to compare to is what they have chosen and what you have chosen, Chris.
Yeah,
And
so yeah, I just pulled up the Wealthfront one, their classic portfolio, and they lean pretty heavily towards Vanguard. So they've got VTI for US stocks, they've got VEA for foreign developed stocks, VWO for emerging market stocks, and then you're into the bonds. And so I think I don't have any insights. I don't know how they make their choices, but I suspect that when it comes to compliance and somebody says, you have to do something that's in the best interest of your client, and you say, I chose the cheapest fund, that probably carries some weight. I also know, though, that when years ago I worked with a fiduciary DFA advisor, that they basically chose their funds based on the process I just described, that they used exactly the same process of a factor predicted expected return. And they have a similar duty of care. They have to do what's in the best interest of their client. So which of those two do I believe? Obviously, I believe in applying the factors and the science and doing the math over just choosing the cheapest fund. Yeah.
so what you shared with us regarding small cap blend, do you also share with us the tables that represent other of those asset classes?
I don't.
Okay.
And And the reason I don't is that, as Daryl described it earlier, there's kind of sausage making, right? And so it took a little while to clean that particular spreadsheet up for presentation and make it pretty so that it
Got it.
would post nicely on the website. But as you might expect, when you're in the middle of doing all this recommendations, there's a mess.
I
You
got
make
it.
a mess,
Yeah.
and so I didn't take the time to clean up every one of my messes and share it. Yeah.
So another question that comes to mind is you talked about how Avantis did compared to other funds over a relatively short period of time. Um, and yet the work about these factors go back for decades. It's really whether somebody has been managing this way for a year. If you look like a certain kind of combination of factors, your return should be similar depending upon expenses, I'm guessing. But in some cases over the last years, I know I looked recently at the Russell 2000 fund at Vanguard over a 5 year period has made about less than half what AVUV had made. And so we're in this period where there evidently was a huge advantage to profitability because I'm guessing that's the weakness of Russell 2000 value is that they pay no attention to the quality of the companies. I shouldn't say they pay no attention, but they certainly don't pay as much attention as Avantis does. Um, how does that factor into your decision? What might be a big advantage to Avantis because of a relatively short period of time?
Well, I'd like to use the longest period of time I can. I use 3 years for my regression analysis because it's kind of a little bit of a compromise. It lets me get some of the newer or more recent funds. And then, as you can see on the chart where where I have a fund that has a shorter history, I rerun the analysis for that shorter period of time across its peers so that I have apples to apples comparison. But what what gets captured in the analysis that I think might explain, for example, the Russell 2000 index underperformance is the negative alpha. And the reason I bring up negative alpha is that one of the advantages an Avantis or a DFA have over a straight index fund is that although they manage it much like an index, they don't have to tell the world the changes they're going to make ahead of time. They don't have to telegraph that on this date I'm going to have to trade out of or trade into something. And there's research that says the public published indexes pay a tax for that transparency, that they do get front run and they do have to buy new assets when they rebalance at a disadvantage. And that shows up in the negative alpha. And that gets included in the analysis. And it's part of the reason that some of these proprietary indexed funds, that's the way I like to think of DFA and Avantis, why they tend to have positive alpha or zero alpha is that they're not having to pay that tax.
So one other question I know is in the minds of a lot of our followers um, is this overweighting to Avantis, which you've already addressed. What does give me a sense of comfort is that when I look at the returns well, for example, the best performing small cap long-term performance has come from dimensional funds, DFFVX. And I've talked about it recently in a podcast. over the last 25 years, it has doubled the return of the S&P 500, and it's done even better than that of the Fidelity Select Technology Fund, which has had supposedly a great record in the technology market. So it has done what small cap value was supposed to do over this last 25-year period. When I look at the work of Avantis and DFA, ever since Avantis came on the scene, the returns of Avantis and DFA, they're not the same. In many cases, there's a small advantage to Avantis, and in one case, there was a small advantage to DFA. But these are both organizations that are managing their money strictly by the books. As a matter of fact, this kind of a fund, people will say, well, that's not an index fund because they're trading things, they're making changes. It's an actively managed fund. Well, the minute you say that, so is the S&P 500 an actively managed fund, because once a year they take about 20 companies on average off the list and they add 20. So there's movement going on there as well. But the moves they're making, because their returns are, I mean, they are competitors. They want to beat each other, but their returns, because they come from the same academic background, are about the same. So I really have a sense that when I see that money that my wife and I have given to our 2-year-old granddaughter to hold for the next 90 years, I really believe that is a fund family as well as DFA that will continue to manage money in that way. How the world will end up, I have no idea. But I do believe that that's a stable way of managing money. Do you have any additional comment to make about that?
Well, the people at Avantis, as you well know, came from DFA, many of the people who started the company. And I think part of the reason Avantis was formed was that DFA did not have ETFs. And Avantis came to do that, to pioneer this kind of investing methodology. Both DFA and Avantis are deeply rooted in the work of Fama and French and in evidence-based, rational, academic investing principles. Avantis likes to emphasize the business story a little bit more, which I like. They like to emphasize that, companies with good financials have historically done better, and so it makes sense to disproportionately weight them in the portfolio, and that is a subtle difference, but it's not a fundamental difference because the profitability factor came out of Fama and French's work too. So
Yeah.
yeah, it's not surprising to me that Avantis is doing really, really well in the ETF space because they're the first ones to pioneer a methodology consistent with our portfolios in that space. Go ahead, Daryl.
Yeah. I like to think of Avantis and DFA as cousins,
Mm-hmm.
right? They have basically the same, they're not identical, but they have the same roots.
Yes.
And so they're very similar and they, it's kind of a DFA used to be hard to get a hold of too. You had to go to an advisor.
Right.
Whereas now you don't have to do that with Avantis.
And that may have been part of the reason they were reluctant to embrace ETFs, because once you embrace ETFs, you lose that hold on the relationship with an advisor. And, there was some, I think, customer-oriented, benefit-oriented reason for DFA to want to make their investors use an advisor. It wasn't selfish. I think it was that they knew that these investment approaches can sometimes go through long periods of underperformance, and you want an advisor there to educate the investor and help them understand that when you're at the bottom of that underperformance, you have paid for the return already. Don't get out now because the return is in the future. And so the advisor was serving a purpose for the investor to help them stay the course, and also for DFA to keep their funds funded in those periods of underperformance. And now, in some respects, in the world of ETFs, investors who use them don't have that same security blanket or help, and it falls to us to help educate investors to stay the course through those tough times to get the return and earn it. Yeah.
And by the way, for people who get a little irritated thinking that they're getting involved with actively managed ETFs. And by the way, the government now identifies people like DFA and Avantis as non-traditional index funds. So they have come up with that as a formal name for this kind of a fund. But if you don't think they're doing everything they can to minimize the expenses, you might look at the turnover at both Avantis and DFA. The turnover is very low. So I think in that small cap value fund, their turnover is 8%, which is actually for small cap value, that is very low. So, but I also think you'll find it interesting, and I'm not going to certainly not going to override any of your recommendations, Chris. You're the man. But I will tell you, if somebody looked at DFA's small cap value, for example, and they looked at AVUV and they looked at Morningstar and they looked at the top 25 companies, you'd be amazed at how different there. Yes, there is some overlap. In fact, there's some website, I can't remember where it is, that you can see how much overlap there is. But if somebody making a long-term commitment to small cap value put half their money in Avantis small cap and half their money in DFA small cap value ETF, I would not think that to be an illogical thing to do.
Well, and Paul, you can see on my chart now the relative return, the relative factor predicted expected returns are 1.3% for AVUV and 1.2% for DFSV. So again, I'm trying to be transparent, and whether that's numerically significant or not, I can't even tell you. I just have to pick one that is my recommended one, and it's easier to pick the higher number. But I'm right there with you. If somebody wanted to use the DFA fund in addition or instead, I'd be hard pressed to argue that's a mistake. Yeah.
So, Chris, I have a question. Well, a comment, I think, first, and that's that I think originally Dimensional had you use an advisor because it lowered their turnover, because
hmm
they would or maybe not force is the wrong word, but work with investors to keep them in the stay the course foundation and or approach, and that would reduce their turnover, which would reduce their expenses. And so that would help them increase their return because they would have lower expenses. The other thing is, when you don't highlight a specific time period on here, what time period did you use?
I think that's both.
Does it
It's
say it
down
up
at the
above,
bottom in the
maybe?
notes. The best
Oh,
in-class ETFs are chosen primarily based on the 1964 to 1924 Fama French factor premiums. So the
thank you.
premiums are established from 1964 to 24, and that's multiplied by the November 21 through October 24 fund factor exposures, except where otherwise noted. So yeah,
Yeah,
it's on there.
thank
It's
you.
great work, Chris. Uh, the investors, most of them are never going to get here without help because it's just too much to ask them to do. And this, of course, the big challenge in trying to help a do-it-yourself investor is that we're trying to give you at each fork in the road, including the ETFs that you could put in your portfolio. And we're not allowed to be your advisor. We're here for what the small print says. We're here for entertainment purposes only. But I will tell you, it's the most serious entertainment I can think of, because I do believe that the key to you winning as a do-it-yourself investor is to realize that most of what's out there is pure noise. Most of what's out there has conflicts of interest in so many areas. And most of what is out there is not truly, from everything we know, in your best interest. But you are asked to do the heaviest lifting of all, and that is to have the emotional discipline to do all of these things. And therein is the challenge. And what I can say about your work, Chris, from everything that I've seen, we know nobody knows what's going to happen in the future. I talked to two people this morning that are on their way. One, they're moving to Italy, and somebody else is moving to some other country in Europe. Well, and the third one yesterday, talking about going to Mexico, and who knows what types of chaos all of us are going to have, not just political, whatever. I mean, there's economic, those things are going to happen. And will you have the discipline to stay the course? That is up to you. But we're doing what we can to give you the tools that you need. And Chris, I just want to thank you, and Daryl, you too. I think the work that you've done is building confidence for the long term. We are not going to be alive for the long term, but many of the people we're serving are in their 20s and 30s, and they're going to have to get this. We got to figure out how to keep them on track when the three of us are no longer here. That's a conversation for another day.
Well, sorry if it got too nerdy today, but it's important,
Great.
I think, for people to understand that it's not just some wizard behind a curtain picking things. I'm trying to, and hopefully the data and the numbers help people make smart choices. And really, at the end of the day, the most important part is that you come up with a plan you can stick with.
Yeah.
And so if the data helps you do that, if the data helps you pick funds you can stick with that you don't have to trade in and out of over time, then we've done our job.
And I do think that we should note in the note field, have a link to the sound investing presentation, the bootcamp presentation, because you put the sound investing portfolios together with the recommended ETFs, then the only thing, in a sense, you don't have is how much in fixed income. And you can go and look at last year's boot camp on fixed income, fine tuning your asset allocation. But I will tell you, in a couple of weeks, we'll have the latest version of fine tuning your asset allocation, because once you know the equity asset classes and what percentage is there, what you're left with is the fixed income question. And that's another one that one by one we have to make that decision. So thank you both. Do you have anything else you want to add for the good of the organization?
A very impressive work, Chris.
Yep.
It's not just some guy's opinion. It's informed opinion backed by transparent analysis. So I'm very impressed. Good work.
Well, right back at you, Daryl. If I was as efficient and systematic about this as you are with the tables, it would have been done a month ago.
Well, we're working
And
on it.
and if I hadn't met you two guys, I don't know what I'd be out selling today. So thank you very much. You guys are great. Take care, and thank you for you being here. And please, we don't have a big advertising budget. And so the best advertising we have is when you tell your friends that these people are doing work that if you are willing to do some of the homework yourself, that we think that this is going to be good for your financial future. We have more and more parents telling me that they are convincing their young adult children to dig into our work. And one just yesterday, Chris, had a long conversation, in fact, with a friend of yours, and we ended up making sure that their kids, it's more than two,
Quite a
their
bit more than two.
yes, that their kids all have copies of We're Talking Millions and Two Funds for Life. And if they don't read the other free book there that we have available about spending your way to wealth, they're missing a good book there, I think, to learn some real gems. All free on our website to try to help you and your family and your friends be better investors. So thanks to you guys, and we'll see you next week.